So we're all in on the commodity trade, except for energy. Metals are rallying really strongly. It's a global industrial rebound. Copper hitting its highest level since 2011. Iron ore surging to an 11-year high. The ags are also really on a tear as well. Bloomberg's base metal reporter Mark Burton joining us now to give us his take on this. Mark, some of these markets have been on a tear for really quite some time. If you take a look at the charts, they're getting ever and ever steeper. How sustainable is this move?
Hi, good afternoon. It's a great question, and I think for a lot of people in the metals market, there's been sustained disbelief at the speed of this rally, and if you look at how fast it's moved through the big markers, $6,000, $7,000, $8,000, $9,000 on copper. At each point, you have those doubts, surely, as an investor, where you say, okay, this thing is moving too quickly, and for all of the long-term upside that there is, we're going to see profit-taking setting in from a technical standpoint. Surely we need a pullback. The interesting thing on copper, actually, is that it has just recently been through quite a substantial pullback. Investor positioning looks a lot cleaner now than it did 2 or 3 months ago. So from that point of view, it certainly seems plausible that the bulls will see those record highs that they're calling for. But then secondly, I suppose there's this more pertinent and enduring question about how good high commodity prices are for the economy,
right.
And with prices at such high levels, I think that's becoming an increasingly important question in these markets.
Yeah, not just for metals. I mean, looking at agricultural commodities on a tear as well. Food price inflation is a very real conversation that's being had right now. I want to focus on what is being left out of this rally, though, and that is oil. Obviously, India is a massive crude importer. The virus there creating some questions around demand. But I'm wondering, India is not the only country in the world that is struggling with the virus right now. On the demand side, could we see that kind of reckoning happening for some of these industrial metals as well?
Yes, I mean it's very possible, and this is one of the lingering questions. We've seen very strong demand for things like copper, but it's particularly in China, for instance. But then it's not clear to what extent that's been driven by actual end-use consumption and a more strategic restocking effort on the part of manufacturers as they try to brace against any potential further supply chain disruptions. It certainly feels at this point as though there's not a lot of inventory sloshing around that could be pushed back onto the market at these high prices. But on the other side, there's also a lot of inbuilt expectation about the strength of demand in China, in the US, in Europe in particular. And if any of those pillars of support start to fall over, then yes, I think it's a very real risk in terms of potentially driving prices a little bit lower from here.
All right, Bloomberg's Mark Burton, thank you so much for that. We want to get back to Mark Haefele now, UBS Wealth Management Global CIO. Mark, your take on the rally we are seeing in the commodity complex. How do you play it?
Well, I think, we like commodities. I think what you're seeing is, a realization that the global recovery is, it has been underway in Asia, but it's continuing. And it's now online in the U.S. Europe is not even online yet. That's one of the things you're seeing here. Secondly, I think there's reason to believe that both in terms of policy measures in the U.S., but hopefully a reduction in tensions around the world, that the dollar could weaken further. And then you have the inflation side. So lots of things point to adding commodities to a portfolio. We might not take that exposure directly through the commodities, but try to play some of the equity sectors that would benefit.